Whilst much of the world has been in lockdown, financial markets have continued to operate, often with spectacular results. For investors, some of the greatest opportunities of our lifetime will unfold in the coming years and months. This is not the time to shy away from investment ideas. This is the time to embrace them and investigate their potential for our investment portfolios. We've asked experts from across a range of different markets about why we should invest in them and why now. In this episode, we're throwing the spotlight on gold and gold miners. In a world of parabolic fiat money printing, investors have been rotating into assets such as gold to retain their purchasing power. Eric Muschinski is the editor of Gold Investment Letter and a thought leader in the gold mining and exploration space. I wanted to ask Eric why gold miners provide an opportunity for outsized returns and why now is the time to start investing.
I believe gold is in a secular bull market, and it started under $300 an ounce in 2001. Gold was up for 12 straight years, which is pretty crazy within itself. We've seen I think, healthy 5-year correction. Last summer in 2019, though, gold had a huge technical breakout above $1,400. That was a 6-year ceiling.
Central banks have opened the monetary floodgates and governments have embarked on a fiscal spending spree. Now there are fears of both inflation and deflation. So what are the macro tailwinds for this sector today?
The macro backdrop, it's incredible for gold. I think it's going much, much higher, certainly in terms of price in US dollar, but most other currencies are well into new high territory already, above 2011 levels. It's a space that's very under-owned by investors, but we're coming out of the longest and most severe gold mining sector correction in 77 years, which happened from April 2011 through January of 2016. What I think is amazing is that after initially tripling in 7 months during 2016, the sector, the gold stocks, they've basically been treading water until now. GDX just finally broke their 2016 highs in March. Gold did so last summer. The smaller exploration development companies are still trading near 2015 bear market lows. It's a big, big disconnect. On the value side, over the past decade, gold miners are down 25%. And you look at the same thing with the S&P, which is tripled. We only have one company in the S&P that's represented in the S&P 500 as a gold company, and that's Newmont Mining. So there's very little exposure broadly, especially with this passive investing bubble that we're involved in now. And the economics have drastically changed with $1,700 gold. You know, these are companies that have tightened their belts and had to keep them tight for a very long time. Now we've got energy costs that are falling and plummeting, which is their biggest cost, higher gold prices that nobody's been modeling in. Certainly, I don't think any analysts on the street had $1,600 gold into their projections for Q1, for example. But if you go back to even like late 2018, investors had a glimpse of what was starting to happen. When the Fed was unwinding their balance sheet, the gold miners were up 23% from their summer lows, and the S&P corrected 20% into the end of the year. So 43%, difference in performance until the Fed reversed course. But over the trailing 12 months from today, GDX is up 75% versus 3% for the S&P. So, how much longer is the big money going to ignore that? I don't think they're going to ignore that for long, and I think that the Q1 numbers are going to start to get even further attention in this space. In this environment we're in, gold miners actually have earnings growth. They're heavily discounted on the future cash flows. If gold goes to new highs, which I firmly believe that it will in the US dollar, who's got that modeled into these numbers? And the thing with the miners is the leverage they have, the massive leverage to the gold price because they have fixed costs. I'll give you an example. Newmont Mining, which is the company that is in the S&P 500. In late April, they increased their quarterly dividend by 79%, while obviously many sectors were just getting smoked or bailed out. On May 5th, during their Q1 earnings release, which they handily beat, they stated that they can produce $1 billion a year in cash flow at $1,200 gold. But every $100 increase in the gold price gives them an additional 400 million annually in cash flow. That means that at $1,700 gold, you're talking about $3 billion cash flow, which is tripled from their projection at 1,200, and that's on a 40% increase in the gold price. That just shows you the power of the leverage on the upside in these markets. And, again, you just have to consider that these groups have been having to model in surviving and trying to make money between $1,100 and $1,300 gold for 7 years.
I also wanted to understand how gold acts as a store of value and helps to protect investors and ultimately consumers against the deterioration in government finances.
Anyone who does not own gold at all, especially in this environment, just simply doesn't understand its function. The gold price since 1971, when it was obviously delinked from backing the US dollar, is up 50-fold in 50 years. I don't think many people realize that. In addition, it's also compounded at over 8.5% a year over that same time frame. The almighty US dollar, you need over 6 times the amount, approximately, in dollars to purchase the same goods. People tend to measure gold's performance against equity markets, which is fine, but its primary role is as a store of value. It maintains its purchasing power over time against fiat currency dilution, and it's done this for millennia. We've got exploding deficits in the US, obviously around the world, but we'll focus on the US. Falling real rates is always a big driver for gold, and huge debt monetization via currency debasement and printing. The last thing that I think is something you have to throw into the mix for gold is any loss of confidence in governments will drive demand for gold as well. This whole it doesn't pay interest crowd will even consider it now that they're going to have to pay 100 basis points or 200 basis points for a 30-year note in fiat currency that's, if they're lucky, going to be worth half as much at the end of that duration in terms of purchasing power, if they're lucky. The average gold mining sector bull market has returned 440%. That's going back to the 1940s. And they've lasted as long as almost 400 weeks, which is 7 years. The current cycle that we're in, though, in the gold miners, which began in January 2016, is tracking most like the 2000 to 2008 bull cycle and also the 1960 to 68 market. Both of those cycles peaked up over 600% around week 370. Right now, we're 220 weeks in, and we're up under 100%. We're up just over 90% versus the 600% average in those two markets, and they track very, very similarly. So the big juice in the miner move, I believe, is it's just ahead of us. And I also am a big believer in the Pareto principle. So 80% of this move should come in the last 20% of its duration, which is also exactly what happened in those two other timeframes.
There are ETFs and indices on gold miners, but I asked Eric to outline a couple of individual gold mining equities that highlight the excellent opportunities that can be found within this sector.
In the gold investment letter, yes, we cover producers, bigger companies, but we go down into the ghetto of the exploration juniors, very, very tiny market caps. The two examples I'll give today are somewhat in the middle. They're both New York Stock Exchange listed, Toronto Stock Exchange listed, market caps between 100 and 500 million bucks. So their potential moves could be much greater than GDX, for example, which is the main gold miner ETF. Just as of early May, we're starting to see some bids down in the bottom of the market. So we'll see if this continues. But the first deal I'll talk about, I think, is very interesting. It's a leveraged development stage company called International Tower Hill Mines. They already have $18 billion worth of gold reserves and resources in the ground, over 12 million ounces, 9 in the reserve category, which is important because it gets a higher value. It's been taken further. There's been more work done on that. And so the per ounce valuation in the ground should actually be fairly significant because of the stage. It's actually the largest gold-only deposit in North America that's not wholly owned by a major mining company. It's beyond the pre-feasibility stage. They've done tons of work on this thing. There's been like almost 800 holes that have been drilled on this project. When they calculated in the last study, the 9 million ounces in reserves was done at $1,250 gold. This 12 million ounce resource total is probably over 20 million. So the issue with the Living Good deposit they have in Alaska, it's really simple. It's lower grade on the gold spectrum. So everybody's known that they need $1,500 gold to get into the conversation of somebody who's going to get serious about, building a mine here. But, the net present value juice on this thing in a rising gold environment is insane. It rockets up 15x with just a 0.7x move in the gold price. And I'm using this from one of their slides showing the move from $1,500 to $2,500 gold. And the stock was over $10 in 2011. The asset was much, much smaller. It's trading like gold still at $1,200, but this is probably one of the two cheapest stocks, I think, in the entire industry. But when you look at, even though it's a quote unquote penny stock, they have over $100 million market cap. They are exchange listed, so it's not a tiny little TSXV company. And the other thing you have to consider is the smartest money in the sector owns over half of the company. I think this is a temporary anomaly with symbol THM in the US trading at these prices. And ultimately, it's going to retest, and we'll see what happens. My view is it'll even explode through the 2011 highs at some point. That's a lot of potential beta on that name, and you'll notice that it's been basing for about 5 years, ready for that breakout move. The second one is a deal that I've followed since 2006 called McEwen Mining, symbol MUX on the New York Stock Exchange and also on the TSX. I followed this thing earlier on in my gold mining investing career, and upon the news that Rob McEwen, who his name's on the door at McEwen Mining, was coming into a shell with just 3 Nevada-based exploration projects, it went from pennies to $10, like very quickly. McEwen's really well respected in the space because he grew Goldcorp from a really small, less than $50 million market cap to multiple billions of dollars. And it was during the 1993 to 2004 timeframe, and that particular market was not so good until around 2002. Investors, though, that were with him during his tenure, they made a 31% annual compound return. After the 2006 pop, then we had the 2008 crash. I literally recall sitting at my desk. At that point, it was called US Gold, symbol UXG, and I was partially filled on a limit order at 38 cents a share, which is where it bottom ticked. Within 2 years of that bottom, it hit $10 again. Then during the really bad bear market, the worst in 77 years that we had from 11 to 16, it hit a low of 64 cents in late 2015. And then we did have a big run in the gold miners in 2016 into the summer, and the stock went to $5. Now, it just hit a low last month of 53 cents. So this is way back down to other lows that we've seen in crisis situations. They've got 5 operating mines now versus back in those other days, it was either nil. I think in '08, they were just starting their first mine in Mexico. They've got 4 projects that are in the pipeline for new mines. And this is a huge deal. Rob McEwen owns 20% of the company. And he literally wrote checks for $164 million to get that stock. So his cost average is about $2 a share. And the stock right now is just below $1. He takes $1 salary per year. And the only way that he gets any value is by shareholder appreciation. In the back pocket of McEwen, which people are giving no value to, is one of the largest undeveloped copper assets in the world. It's called Los Azules in South America. The after-tax NPV on this thing is $2.2 billion. That's assuming copper's at $3, and it would have a 36-year mine life. Plus, there's a lot of room for growth. It's huge. McEwen's entire market capitalization is $400 million right now. And now with the $1,700 gold price, I'm very confident they'll be profitable going forward. And just this Los Azules is a monster, and it's likely worth more than the entire market cap of MUX. The CEO is a world-class operator. This thing isn't going anywhere. He's a billionaire. Will it go back to 10 like it did twice before when they had a tenth or a third of the assets they have now? I think so. And just like the International Tower Hill, depending on how high gold goes, if gold goes to new highs beyond the 1900 and change, which I'm confident that it will, we could see it go even higher. So these are the type of risk-reward situations that we're seeing in the space as you go a little bit down the ladder. What I try to do is we dig a little bit deeper in terms of the market capitalization of some of these companies that could have some real beta and torque in a gold bull market, because the beauty of the gold mining industry is the leverage in a rising environment. And some of these smaller stocks, this is where you get the comps to Bitcoin, because if you go down to the junior realm, these are not small companies with tiny investors. They have huge asset bases with some of the smartest money in the world owning most of the companies. And just to go back to their old highs are going to be 10 to 13x from where they are today for those two stocks. But if you go even lower into the juniors, which are trading, for sub $50 million, $25 million, $10 million market caps. These are the type of stocks that in the 1970s and even in the move in the early 2000s, 25, 50, 100 baggers, they occur and they'll occur again. So, that's why it's an exciting space in the mining area versus just gold. We're going to have an entirely new generation of people when gold goes over $2,000 an ounce to new highs that don't know anything about this space. They don't know who Rob McEwen is. They don't know about Electrum Group. They don't know, any of the players, Eric Sprott, the ones that, Ross Beatty, the billionaires, the big players in this space that you want to bet alongside of, Lucas Lundin. These are names that people don't know. We've had essentially a 7-8 year bear market that's happened up until now. And some of the valuations are very ridiculous here. And it's a great time to take a look at the space because, things are cheap.
One of the most important questions is always around timing. I wanted to know how far this theme could run and if potential investors could be in danger of being left behind.
We see adoption in waves in secular and cyclical bull markets and bear markets. You have the value people that come in early after something's been decimated. Usually in phase 2, you start to see the smart money, the smartest money, the institutions that come in. And then in phase 3, you have the blow off top, retail, brokers, different folks that are chasing, the action. What we've had happen in the last year or so with that technical breakout in gold, Ray Dalio, Paul Tudor Jones, Stan Druckenmiller, Peter Thiel, these guys are smart money, right? They're very, very significantly positioned in gold and are typically early to the party. They're not late. It's literally just getting started. The train is just leaving the station in terms of gold, silver as well, which is historically ridiculously cheap in terms of the silver to gold ratio. And in particular, the mining stocks. If you're not paying attention to it right now, the risk is gold's at 2,500, 3,500 in a year, and you're paying attention to it after these stocks have already gone up 7, 8, 10x, and you'll think they're safer, but they're not.
There are clearly many tailwinds for gold. The aggressive money printing by central banks could now accelerate even further the loss of purchasing power for many currencies. Today, institutional investors, with their considerable firepower, are beginning to engage with the sector. And for the gold miners, this opportunity is still in its infancy. These are stocks that have been overlooked in recent years, but when gold gets going, the miners can move multiple times further than the underlying commodity. So if you haven't looked at gold miners before, now could be an excellent time to engage in the sector in order to avoid the disappointment of potentially being left behind.